Good morning, everyone. Welcome to this rundown for the 22nd of January for global stocks and commodities. I thought this week that I would look back at what we had in 2016, particularly in the American market, because that's what drives everything around the world, and see if we can work out a little bit of a rough blueprint for how things may unfold in 2017. Now, of course, you'd need to be living in a cave to not know that Donald Trump is now the President of the United States, and of course that has ramifications for markets. But it is not going to change the way that markets or economies behave, in my view. It's only going to accelerate some of the trends that were already in place already. So I think we're in for probably a fairly volatile year because he's unpredictable, and some of his policies, if they can get through, are certainly going to have very significant impacts in the shorter term. So I expect to see plenty of volatility, but it's possible that that net the market doesn't really go anywhere much at the index level. Anyway, let's not get too hung up on what might happen because we're just going to play it as it comes. But I thought looking at 2016 was certainly a worthwhile exercise. So just a bit of a perspective first, and this is similar to what I said last week, and it's really never been more important than now because the media is just absolutely dominating everything these days, and markets are responding in the short term to the media, and it makes it very, very difficult for traders and investors in this sort of environment. So the important thing is that you get the underlying trend correct, not the day-to-day ups and downs, but the strong underlying trends. And changes to your strategy should only be made if there is a significant change in the trend or demonstrated proof that the trend has changed. And we've had a couple of instances where it looked as though the trend was changing over the last couple of years. And we took some short-term evasive action, but it turned out that they were just false breaks of support, and within a day or two, the markets had rebounded back into the range or back into the trend that they were in. And so from time to time, it will be prudent to take some action, and that action may prove to be unnecessary, but it's just the way that we have to operate in the markets these days. I would really caution you against trying to be too cute and trying to fade the rallies. There are calls at the moment for some weakness in the next couple of months in the market, and I think that's entirely possible. But am I going to try and trade it? Not on your life. It's just too hard in this sort of market where the trend is up to try and play the short term to the downside. So I would absolutely stay away from that. I think, cash up a little bit from time to time, reposition yourself for the next phase up. But at the moment, we're still in a market where it's a case of buying the dips. Now, another question that I do get is it worthwhile waiting for a pullback in the market before essentially entering and ramping up your exposure? So the question that goes with that, of course, is does the possibility of getting a lower entry price, does that offset the likelihood in an uptrend that you're going to miss out on getting on the trend altogether? And of course, on a case-by-case basis, we can never know the answer to that until after the event. And that's why I think you've really got to perhaps do a little bit of both. When the markets are poised as they are at the moment, where they've had a terrific run up, we may get some short-term consolidation of maybe the order of 3 to 5% to the downside, which would be pretty normal. Then I would certainly not be out of the market completely. I would have some cash available to buy the dips, but I wouldn't be holding back with everything that you've got to get the best entry you can, because the overwhelming chances are you will miss out. Turning now to American stocks, the S&P was essentially flat for about the third week in a row. We were down by 2 points. And this stair-step uptrend that we've had through 2016 remains in place, and we're really getting an absence of extremes. And I think that's something that has allowed this trend to be sustained, that we haven't really moved to extremes on the upside, and we haven't really moved to extremes on the downside. It's just been a fairly low volatility progression. Yeah, we've had a couple of spikes in the VIX to above 20 and once above 30, but they were very, very short-lived. The VIX remains at extremely low levels, and I don't think it's really complacency because there's a lot of money that is still not in the market that can come in. So I don't get a sense of complacency. I just get a sense that that people are are not too concerned about the downside. They kind of feel that the US is not in danger of going into a recession, and therefore we're going to get a continuation of this uptrend. Now, if we do get a move down in the US, and I think that's entirely possible, then that would be the retracement zone that I would be looking for, just a tick under 2200 up to about 2230. The market's currently sitting at 2270, so we're talking about 40 to about 75 points of downside, which is pretty mild, really. There is a need for a pause, as we'll see. If you look at 2016, where the market is positioned at the moment, there certainly is a need for a pause. And we're in the middle of earnings season. It's critical. The main winners, I expect, in earnings season, and we're seeing some of it unfold already, is energy, semiconductors. There's a great report out on Thursday night from Skyworks, and that led to a sharp rise in the whole semiconductor sector. And of course, some of the financial results have been coming through pretty well also. So I expect they will be the main winners in earnings season. The last 3 Januaries, 2014, 15 and 16 have been negative on the index. Now, what does that mean for this year? Look, I don't know. I don't spend too much time thinking about it, but it's just an interesting observation that the year has started out on a negative note. There is an old Wall Street saying that says, as January goes, so the year goes. Well, that's been shown to be false or no longer valid for the last 3 years. So whether we'll get back to normal this year or not, we'll know in 12 months' time. But yeah, just an interesting observation there. So let's take a look at the American market. Sorry, let me get the right screen. So this is the S&P, and let's take a look at the last 12 months. So this was January and February of 2016. So the market sold off quite sharply. There was some real concern around the market at the time that we were going into a protracted bear market, and all we got was a period of volatility that only lasted about 6 or 7 weeks. We formed a double bottom, and then we got a significant move up. So that was the first of our stairs. So there's our stair. We then went into from April, about mid-April, until the end of June. We then got a period where we essentially went sideways. Now, it got a little bit volatile in June, and that was around Brexit. So this was the Brexit effect down through here, these 2 big red candles. But if you just ignore those couple of days, so if you're looking at a weekly chart, then all you're going to see is a fairly narrow sideways pattern that lasted for about 2.5 months. We then got another stair to the upside, not as big this time. So that ran from July through to August. The market went sideways then for about 3 or 4 weeks, the same as we've done here. And we then got into another consolidation zone that ended with a market decline just prior to the US election. Wasn't turned around by the US election, but certainly led almost up to it. But again, that's another fairly clear sideways consolidation. Yes, we got a bit of a sell-off at the end, and I'm sure some people panicked. But when you look at it on this sort of view, it just gives you a much sharper sense of what it's about. And we then got the next step up, which was already in play before the US election, but was certainly enhanced by the US election. And now we're back into another sideways pattern again. So it would certainly fit the normal pattern if we then got another step that perhaps lasted over the next couple of months, and saw perhaps 3 to 5% downside. So on my estimations, we're looking at somewhere just a tick under 2200, and perhaps only down to around the 2230 area. So I think that's likely what we're going to see in 2017. However, we may well see greater volatility because of the fact that Trump is going to do unpredictable things, and the market is going to respond to that. So I think that's probably as good a roadmap as I can give you at this stage. But look, don't lock anything into your subconscious about what should happen. Just basically be aware of the patterns that have existed. The US economy is moving ahead. They're in no danger of being in recession. If Trump can get half of what he wants to get through with tax cuts and removing red tape and infrastructure building, then this is going to have a massive stimulatory effect on the US. That's also going to be positive for the world's economy because it'll drag others along with it. Now, yes, there might be some disruption from his protectionist policies, but net, it's still hard to see a global environment where we don't have economic growth. So I expect that 2017, the way it's looking at the moment, is going to be a volatile but probably positive year. Turning now to Aussie stocks, the Aussie dollar steady at 75.5. The US dollar has cooled off a bit as it needed to do, and is sitting right on key support at around 100. So it'll be interesting to see what happens there with the US dollar. The ASX 200 was lower again by 66 points, and it's really the banks were the main losers. So that's 2 weeks straight now after a big surge in the banks. The resources sector certainly has some momentum. It's not shooting the lights out beyond BHP and Rio, but there's certainly some momentum there. But look, much of our market is doing nothing. It's pretty boring and lifeless at the moment. Let's just take a quick look at the ASX 200. So there you can see we had a strong move up that peaked on the 9th of January, and we've been heading down since, and may head down a little bit further to test this breakout at 5,600. So that's the Aussie market. Turning now to precious metals. The price of gold moved higher, and this was despite the lack of buying in GLD, which is the main ETF, and also a lack of repositioning in the futures market as well. So that's really interesting that gold would move up in the absence of two of the main drivers. I'm not sure what explanation to put on that, but I'm sure it'll become apparent in coming months. Now, at least the holdings in GLD have stopped falling. They peaked about 980 tonnes in July, and they got down to 803 tonnes just a short while ago. They've stopped falling. They're back to about 809. And so that means that big liquidation in the ETF market, which has then, of course, spilled over into the physical market, has steadied. Also, the futures market is at a position that I think is pretty conducive to gold going higher. Now, the reality is that the futures market controls the short-term action in the gold price for two reasons. One, because of the extreme leverage that they use, typically of the order of 20 to 25 times leverage. And so therefore, when the market starts to move in a given direction, be it up or down, the long speculative futures traders are forced out very quickly. They have no choice, irrespective of what their personal view is of gold. If a 4 or 5% move down in the gold price can wipe them out totally when you're using 25 times leverage. So they have to move and move quickly. So leverage is one, and secondly, it's the psychology. If you've got selling in the futures market or buying in the futures market, it spills over into the ETF and the physical market, and vice versa. So these two markets, whilst they are separate and they are driven by different people, we've got speculators in the futures market and you've got more longer term investors in the ETF market. The fact is that the psychology spills over from one to the other and creates these self-perpetuating cycles that run longer than what you would expect. And I spoke last week about the fact that we had a fear trade in January and February of 2016. So stocks went down sharply. People got very fearful. The VIX went up and gold went up, which is exactly what you'd expect. But then the fear disappeared. Stocks went on a terrific run, yet gold kept rising all the way through to July. So that market, once it started to trend, the fact that the fear trade had disappeared, that market was able to be sustained because of this self-feeding effect that happens in the ETF and the futures market. It's very important to understand when if you're going to trade in precious metals, it's really important to understand the mechanics of those two markets and also the psychology effect and how it's self-perpetuating. Now, right now, where the futures market is sitting, where we've got a low level of speculative longs and a relatively high level of speculative shorts, is highly conducive to the gold price moving up, because inevitably when you get to an extreme in any market, but particularly in the futures market, when everyone is positioned one way, then it's almost certain that we're very close to the market reversing and going the other way. So therefore, I think the current futures positioning is very positive for gold. And the fact that gold has moved up without the futures and the ETF market helping is, I think, supports that. Gold was up $9 on the week, and precious metal stocks were marginally higher. Let's take a look at those charts. So we'll start first of all, this is silver. So silver edged ahead just a little bit on the week. Gold similarly, if we just look at that on a weekly chart, you can see gold managed to edge ahead a little bit. So there's nothing dramatic happening in that market yet, but I would expect at varying times during the 2017 we're going to see some bigger moves there. Just looking at GDX as a proxy for precious metal stocks, you can see it's been quite a nice move. We've formed a higher high, haven't really had a pullback yet, so we can't really say that we've formed a lower low, but the absence of a pullback itself is a fairly positive aspect. Turning now to other commodities, copper just eased back a touch to 259, and the positive outlook for copper stocks is still unmistakable. If you look at the majors, BHP, Freeport McMoran, those sort of stocks, very, very strong trends in place. Crude oil slightly higher, got back up above 53 on Friday night. There's not really been a big definitive move in energy stocks yet, but I think the earnings season is critical. And markets are probably waiting to see how those earnings results come through. But certainly the signs for I don't know that the signs for the energy sector are highly positive yet, but they're certainly not negative. And I'm completely confident that we've seen the lows in the energy market. Doesn't mean in the short term we can't see a little bit downside, but I think on a longer term view we certainly have. There's the spot copper chart. It's really been elevated since about the middle of November. So just to wrap it up, as I try and make the point in summary every week, strategy and process is vital. The reason that I keep reiterating this is that in my experience over 15 years in dealing with thousands of different traders and investors, that hardly anyone really pays much attention to getting their strategy and their process right. And then, of course, secondarily, you've got to stick to it. So it's just so important. I keep emphasizing it all the time. I think you can continue to buy the US dips with some confidence, and to assist even further, place more of an emphasis on the sectors that have been out of favor and that are turning higher. So that will minimize the downside risk in a general correction. And I'm pretty confident we're going to see a few general corrections this year, perhaps not exceeding 10%, but look, who knows. Don't react to short-term fluctuations. You'll just get yourself in a hell of a mess. Just be very clear about what you're doing and stick to the game plan. As I said right at the start, and the exercise that I showed you with that stair-stepping pattern in the S&P through 2016, I think it's quite likely that we're going to get a couple of months of reaccumulation here. The market could drop 5%, but I would say that would be a good buying opportunity. So just be very clear in advance about what sectors and stocks you want to buy. Don't wait until there's a correction, because then you're scrambling around, you're influenced by the media. Get your house in order now, be very clear about what you're doing, and have a rough idea of where the price support is that you'd be prepared to start to increase your exposure. So that's it for this week. There's my contact details for non-members. Always happy to chat and offer some assistance where I can. That's it for this week. Cheers.